Now, the Nigerian equities market extended its positive momentum, marking a 20-day winning streak as of today. Now, analysts attribute this rally to strong corporate earnings in the first half of the year. Now, since the start of July, the all-share index has gained roughly 14.8%, reflecting sustained investor confidence. Oreoluwa Odetunde, Head of Research at Anchoria Asset Management, joins me for more market updates. Ore, massive rally, 20 days, right?
Yes.
And it shows how well investors are positioned, you know. A lot of people going for bellwether stocks now. How do you think this will be sustained? How long?
So I think we still expect these bullish activities to remain sustained. We've seen that corporate earnings has been what has mostly driven the gains that we've seen in July. And you did mention that the market is up by over 15%. That's close to 50% return of the year to date. When we look at the market on a year to date return. So I think that we still expect, these positive sentiments to be sustained. We're seeing that, these companies are able to churn out much more impressive numbers. Also, fixed income yields have actually been declining. We saw that at the last bond auction, the 2032 bond. We saw that, the marginal rates dropped from around 17.92% to about 15%. So we're seeing that, yields are definitely making their way downwards. And that's why we're seeing, increased portfolio reallocation into the equity market. So we're seeing that there's that support for risk assets at this point in time. So we do expect that, activity should still remain sustained. And when you also look at the inflation numbers, the story still appears quite attractive. Inflation has made its way down from around 24% in January 2025. We printed the last number at 22.2%. And we still expect that, that stability and that deceleration would continue all the way down into 2025. We're expecting that, inflation should approach 20% levels in 2025. So we think that that would continue to support, that allocation we're seeing towards risk assets in 2025.
One of the things you would also say is that one of the things driving investor confidence is the fact that at least there's some level of stability, macro stability right now. We're seeing in terms of FPI inflows right now into the market now, the hot money, driving the market right now. But beyond that, now let's look at some sectors. Let's look at cement, for example. Now, it shows that the concerns about FX volatility is over. Now, look at the cement giant so far now and how the industrial goods has turned over within the last few months now. How would you describe that?
I think it's been pretty positive. And if you look at the industrial goods sector before we started to see their H1 earnings, you'd actually see it was in the negative. I think it was 3% in the red zone. But you see that after we saw that reaction, the market is, the sector is close to, the year-to-date return is close to around 30%. And when you look at, where we achieved most of that, return was majorly achieved in July. And like I said, it was reactions to the H1 earnings releases. First, we saw that, top line growth was pretty decent for most of these companies. But, we saw a bit of softness for Dangote Cement, but for BUA and WAPCO, we did see that, there was significant top line growth, an average of around 40%, which was all majorly driven by pricing adjustments. I think especially for Dangote Cement. But when we looked lower into the income statements, the income lines of these companies, that was where we saw a much more robust growth. We did see that for the gross profit margins for Dangote Cement, that improved to around 58%. Recall that in 2023 and 2024, both the sector was impacted by the significant FX depreciation that we saw. And you know that the sector has a lot of dependence on FX in terms of its energy cost, also in terms of transportation, also in terms of the debt that is being taken on by most of these companies. So we saw that, remember in 2024, the FX losses for Dangote rose to as high as 220 billion. But we saw that, in this H1 numbers, that they actually recorded a gain in FX by about 45 billion. So it was really impressive for investors. Apart from that, we also saw less pressure on the net interest expense of these companies. I think for Dangote, it reduced by about 66%. And also in terms of their operating cost as well, we saw less pressure on that. You look at the fact that operating cost has majorly been driven by higher haulage expenses. But you see that these companies are moving into things like logistics fleets. Dangote has spoken about the fact that it wants to deliver about 1,600 CNG trucks and all of that. So we see that, there is some margin recovery happening and also margin expansion, and investors price that into the stocks of the companies listed in the industrial goods space.
One last word right now before you go. What is your top stock pick?
So I wouldn't speak from the top stock pick side, I would say sectors. I think we still remain bullish on the consumer goods space, as well as, we think cyclical sectors in general.
All right.
If you look at it, we're still quite positive on the banking sector due to the recapitalization activities, and also we expect that earnings should be broader in 2026. So all in all, we still expect that the market should still turn out positive numbers for 2025.
All right, we'll wait for and see how the market turns out by the end of the year.
Thank you.
Oreoluwa Odetunde, Head of Research at Anchoria Asset Management.